It's been 10 years since the 2008 financial crisis. Since then, there have been many who claimed they knew what was coming, but in reality, few really did know, and those who claimed they knew had likely been saying the same thing for years. Just look at the media today or even on YouTube. Many are claiming that the collapse is here now. But if one looks back in time, these people made the same claim years ago. But based on MarketWatch interviews, there were four who came close. I call them the Fab Four. No, not the Beatles. I'm talking about Gary Shilling, James Stack, Raghuram Rajan, and John Malden. Today, we will explore what they said before the great financial crisis and what they say now. So let's take a look. First up is Gary Shilling. And Gary is now the president of Gary Shilling and Company. And he started writing about a housing bubble in the early 2000s, and his work caught the eye of Greg Lippmann. And Greg Lippmann was famous with regard to the movie The Big Short. And Lippmann's bets against the subprime mortgage made Deutsche Bank about $1.5 billion. John Paulson contacted Shilling in August 2006. Paulson talked about credit default swaps, and Shilling didn't know what they were. But Shilling did some consulting for Paulson's hedge fund and even invested. Paulson, of course, loaded up on these CDSs and made $4 billion in what has been called the greatest trade ever. They made 15 times their money. What Shilling said then? Well, back in January of 2004, Shilling said that subprime loans are probably the greatest financial problem facing the nation in the years ahead. In June 2006, Shilling said that the speculative housing bubble's break will cause widespread pain and be much worse economically than the 2000 to 2002 bear market. So what does Shilling say now? Well, he says that the ultimate thing that brings down financial markets is excess leverage. So you look where the big leverage is, and right now I think it's in emerging markets. Shilling is particularly worried about the $8 trillion in dollar denominated emerging market corporate and sovereign debt, especially as the US dollar rises along with interest rates. The problem is, as the dollar increases, it gets tougher and tougher for them to service their debt because it takes more and more of their local currency to do so. And as we know, emerging market debt has been an issue for the past few months or more. Next up is Jim Stack. Jim Stack is president of Stack Financial Management, which manages $1.3 billion. Back when housing prices kept rising, Stack built a proprietary tool called the Housing Bellwether Barometer. At that time, he called housing a bubble a year before it peaked and warned of bigger problems ahead for the economy and the markets. What did Stack say then? Well, in July 2005, he said that we are officially calling it a dangerous bubble. He saw a $1 trillion government bailout of the mortgage industry at some point over the next decade. In July of 2007, he stated that our housing bubble index had dropped into a free fall that rivals the dot-com bust of the late 1990s. He further stated that we are moving to a full bear market defensive mode. In November 2007, he stated we are now nowhere near the bottom. It's only a matter of time until the housing debacle and credit crisis adversely impact the overall economy, increasing the likelihood of a recession. So what does Jim Stack say today? Well, he indicated that the housing-related stocks saw a parabolic run-up in 2016 to 2017, but in January his index peaked, and now it's coming down hard. That suggests bad news on the housing market looking 12 months down the road. But the biggest danger, Stack said, is from low-quality corporate debt. Issuance of corporate bonds has gone from around $700 billion in 2008 to about 2.5 times that today. He added, more and more of that debt is subprime. Uh-oh, Next up is Raghuram Rajan. Raghuram Rajan was the International Monetary Fund's chief economist. He has since served as the chairman of the Reserve Bank of India and teaches finance at the University of Chicago. Well, what did he say back then? He stated that linkages between markets and institutions are now more pronounced. While this helps the system diversify across small shocks, it also exposes the system to large systemic shocks. He further stated that the financial risks that are being created by the system are indeed greater, potentially creating a greater, albeit still small, probability of a catastrophic meltdown. So what is he saying now? Well, Rajan believes that there has been a shift of risk from the formal banking system to the shadow financial system. He further stated that the post-crisis reforms did not address central banks' role in creating asset bubbles through accommodative monetary policy, which he sees as the financial market's biggest long-term challenge. He further stated, "You get hooked on leverage. It's cheap. It's easy to refinance, so why not take more of it? You get lulled into taking more leverage than perhaps you can handle." Rajan also sees potential problems in U.S. corporate debt, particularly as rates rise and in emerging markets, though he thinks the current problems in Turkey and Argentina are not full-blown contagion. But are there accidents waiting to happen? Yes, there are, he says. And then last up is John Malden. John Malden is the Dallas-based chairman of Malden Economics and is best known for his free weekly e-letter, Thoughts from the Front Line, which has 1 million subscribers. What did Malden say then? Well, in March 2006, he stated a slowing of the housing market and thus the economy is in our future. This in turn suggests that as growth in consumer spending slows, a bear market in equities is a high probability outcome. In July of 2007, he stated that the one true risk that is simply not knowable at this point is the credit default swap or the CDS market. The CDS market is huge, in the hundreds of trillions of dollars and growing dramatically. There is no agency overseeing counterparty risk. This is the one true systemic risk that he saw. What does Malden say now? Well, he estimates that the world has almost $500 trillion of debt and unfunded pension and other liabilities, which he views as unsustainable. But he believes that the flashpoint for the next crisis is likely to be in Europe, especially Italy. Greece, he said, is a rounding error. Italy is not. And Brussels and Germany are going to have to allow Italy to overshoot their persistent debt. And the European Central Bank is going to have to buy that debt. If that doesn't happen, the debt triggers a crisis in Europe, and that triggers the beginning of a global recession. But he added, there are so many little dominoes. If they all start falling, one leads to the next. And he further stated that the U.S. economy and markets are doing very well now, but make no mistake, there will be another crisis. Your guess on where or when it will happen is as good as mine. And so for today, that's ChewDog Charts. Thank you.